Greetings and salutations. This is Brian Jarris from Vil Wealth Management. In today's video, we're going to talk about market volatility and what are some investment strategies we could implement to really help reduce any anxiety or stress we may be feeling during these periods. What I love to do is get my clients first to focus on the big picture. So let's use an analogy. Let's say we have a young boy going up an escalator and he's got a toy yo-yo in his hand. Let's try not to focus on the ups and downs of that yo-yo represented by the day-to-day market fluctuations, but instead let's focus on the escalator steadily moving upward, symbolized by the long-term market growth year over year. I've been talking to portfolio managers for years, and there's two common themes. Number one, they feel pretty confident about when to pull back from the market as a bear market is approaching, but they do not feel confident about knowing when to get back in the market. So what I would tell you from all my years of experience is what's most important is time in the market, not timing the market. Now let's look at two important examples of that. If we look over the last 30 years at the 50 best market return days, do you know that 50% of those days occurred during a bear market? Well, what's the value of that? How much would that hurt you? If you missed the top 10 days of the last 30 years, you would have missed 50% of the market growth. You missed 30 days of those last 30 years, you would have missed 83% of the market. So again, the most important thing is time in the market, not timing the market. Let's talk about 7 important investment strategies that we should be considering. Number 1, keep cash for spending. Kind of a rule of thumb is 1 to 2 years of your spending needs. Most bear markets last on average 9.5 months. So by having this 1 to 2 years, when the market is down, we're able to pull from those cash reserves and not have to sell our assets in a down market. Number 2, don't invest short-term money. So any funds you need in the next 7 years should not be invested in the market. It should be invested in cash or fixed income type securities. So if you're going to retire in the next 7 years, you'll probably have at least 7 years of spending, again, in cash or fixed income. And then the rest can be in growth and equity investments. Number 3, rebalance your portfolio regularly, whether that's monthly or quarterly, or maybe you're setting a threshold percent, like 15 or 25%. The importance of rebalancing is realigning your portfolio back to your risk tolerance for what you're comfortable with, not taking on excessive risk. Another benefit is you're basically pulling your gains off the table. So you know the old expression, buying low, selling high. That's basically what you're taking advantage of there. Additionally, you can utilize tax loss harvesting in your taxable accounts to optimize your tax situation and enhance your overall performance. Number 4, maintain asset allocation. Asset allocation is critical to balancing your individual risk tolerance, your time horizon, and your financial goals. Asset allocation is one of the primary drivers of your overall investment outcome and performance. 90% of financial experts do not outperform a diversified portfolio over the long term. Only 22% of active fund managers outperformed their passive peers in the last decade. By thoughtfully distributing your asset classes across your portfolio, you can optimize your portfolio for better results. Number 5, keep fees and expenses low. I would highly recommend considering exchange-traded funds for your retirement accounts. For your taxable accounts, considering a strategy of exchange-traded funds and maybe direct indexes as well. This really can be beneficial if you're in a higher tax bracket and you're trying to take advantage of tax loss harvesting. Higher cost funds do not consistently outperform lower cost funds over the last 10 years. Number 6, stay the course at work. If you're still working, still make sure you're contributing to your retirement accounts, your investment accounts. Remember, you're buying in at cheap prices. You're buying in low. If you are already retired, go back to investment strategy tip number 1, keeping that 1 to 2 years of cash spending needs. Number 7, update your financial plan. A financial plan is critical to protecting your retirement, especially during economic downturns, as well as adhering to the 6 previous investment tips that we went over. So in summary, stay calm, don't do anything rash, try not to focus on the day-to-day market fluctuations, but do focus on your long-term goals. This is Brian Jarris from Vil Wealth Management. We can be contacted at vilwealth.com. I'm not currently your advisor. So again, this is from an investment education perspective. If you need tailored, customized advice, reach out to us at vilwealth.com. Thank you.